Good morning, everyone. My name is Ken Leon, Director of Equity Research at CFRA, and we are delighted to have you with us today to talk about the 2020 Foresight Equity Outlook for the year ahead with Sam Stovall. Sam is our Chief Investment Strategist, well known in the marketplace. He is our lead thought leader as it relates to outlooks for the economy, market, and sectors. Sam is also the chairman of the CFRA Investment Policy Committee, where he focuses on market history and valuations and industry momentum strategies. Earlier this week, on December 9th, Sam published the 2020 Foresight, and also Sam is a noted author, most recently, The 7 Rules of Wall Street. Excellent book. So with that, let's get into the presentation, and I'll turn it over to Sam. Good morning.
Well, good morning, Ken. Good to talk to you. Basically, we wanted to have a bit of a conversation about our outlook for the 2020 year ahead of us. And in a sense of doing a quick review is what I want to get started with, to sort of remind investors that, you know what, the market pretty much told us that it was expected to see a positive return in 2019, and there were hints that it would end up being more than just positive, but it would be very, very strong. Our 2020 target for the S&P 500 is 3435. Sounds a little bit like that old song by Zedgar and Evans, In the Year 2525, but 3435, which implies a 7.3% price appreciation over what we think will be an end-of-year number of 3,200 for the S&P 500. And conversationally, Ken and I will talk about what is the rationale that I think will be supporting this target price, and what could go wrong. Where could I misguide and so forth, and then finally give you all some ideas as to portfolios that we can discuss.
One thing I want to note is that you can submit questions using the GoToWebinar panel, and we'll do our very best to answer questions at the end of the presentation. Go ahead, Sam.
Based on the next slide, I mean, through the end of November, we had a very good performance. The S&P 500 up a shade more than 25%. 10 of 11 sectors were in positive territory. Poor energy, the perennial underperformer, was down 0.5% for the year through the end of November. But encouragingly, we had very solid breadth, meaning that 91% of the 147 sub-industries in the S&P 500 were in positive territory. That's encouraging, because if you have very, very narrow leadership, that tends to be a cautionary signal, because should those leaders end up stumbling, the other ones are already in negative territory.
So in the case of cyclicals versus defensive, maybe 2019 an anomaly, or one where every area really benefited?
Well, every area did benefit. When you look at the sector performances, other than energy, they're all in double digits. And so, I would tend to say that there was only one also ran. And what we did see was that, in general, it was the cyclicals that did the best. Technology, communication services, industrials, financials, being those that were equal to or greater than the market as a whole. So, I think that basically because the Fed hinted that it was going to be cutting interest rates and then actually did so, that really sort of lit a fire under the cyclicals. So quickly for a review and then a forecast for 19 and 20. What were some of the clues? Well, first off, we had a pretty tight spread return, meaning what was the best performing sector in 2019 versus or I should say, in the end of 18, the sector spread between the best and the worst was pretty narrow. And historically, whenever you've had this tight of a spread, it acts like a compressed spring, so that in 2019, it implied that we would probably have a double-digit price appreciation. Double bump barometer, that indicates that if the market is up in both January and then again in February, which had been the case 28 times since World War II, the market posted a 24% average total return in the subsequent, in that full calendar year. So January and February of 2019 were positive. Third year of a president's term in office, normally up 16%. And other than two flat performances, essentially it was always correct being in positive territory. We did have headwinds, which added to the volatility overall. China trade, which really still is a headwind. Eroding earnings projections. A couple of weeks ago, I wrote an article called Directionally Challenged, because the market was going higher while earnings estimates were coming down. Investors were very worried about an inverted yield curve. Yes, every recession was preceded by an inverted or flat yield curve. However, not every flat to inverted yield curve led to recession, but it did lead to the Fed starting a new rate cutting cycle. So with the rate reduction cycle, history says, look, the market's up more than 10% 6 months after the first rate cut. And we did see that kind of upward trajectory, and then finally benefits for 2019 with the lack of attractive alternatives.
So Sam, when you look at the S&P 500 target, 3435, and the right side to the 2020 forecast, what would be one or two key signals that gives you confidence with your target?
Well, I would say, first off, you can look to history. It's a great guide, but it's never gospel. So history would say the tight return spread is still there. It's a little looser than it was last year, but still below average. And so that could be an implication of another spring advance in 2020. Plus, the fourth year of a president's term in office is usually fairly optimistic. But let's add fundamentals themselves. We expect the Fed this afternoon to continue to be promoting a monetary policy that is favorable, that even if they're not going to be cutting rates in December and for much of 2020, still we don't think that they're going to be raising interest rates. So a favorable monetary policy, plus we expect to see a recovery in earnings growth expectations. Prices lead fundamentals. Right now, prices are telling us that it believes that we are underestimating what GDP and earnings growth will be in 2020.
So when we look at the current rate environment in terms of rate cuts or rate rise, what will that mean to the equity market, especially if the Fed's going to be on the sidelines for the next 9 months?
Well, again, I looked to history for a guide. 12 months after the Fed started a rate reduction program, the market was up 14% on average. And then 18 months later, meaning through the end of 2020, the average price change is 84%. Is 18% with an 84% frequency of advance. So, basically the thing is we want to make sure that the Fed is not going to be signaling the potential for a rate increase. But if we are maintaining a favorable monetary policy by the Fed, then the positive 6-month number then morphs into a favorable 12 and 18-month performance. And let me add one more thing, and that is that the dividend yield on the S&P 500 is higher than the yield on the 10-year note. Going back over 65 years, what I have found is whenever that has been the case, the market was higher by an average of 18%, similar to a Fed reduction period, but market higher by 18% in those years because investors say, well, wait a minute, I'm not going to look to the 10-year bond if I'm getting paid more in stocks, and if there's growth potential from the equity prices, well, then I'll just stick with that, and therefore I think the lack of attractive alternatives plays into 2020 as it did in 2019.
And fortunately, we're not in an inverted yield curve anymore, which perhaps gives confidence about the economy.
Right. Well, we were in an inverted yield scenario for a couple of nanoseconds. I don't even think we closed the day in an inverted environment. And at least going back to 1960, I look at indicators of recession, because I believe that bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. And, you know, typically we have been in an inverted yield curve scenario for an average of 11 months prior to a recession starting. And like I said, we have not been in one for a single month, let alone a single day. Question that I frequently get is, well, how does the presidential cycle play into this? Well, look at year 3, because that's the year we are closing up right now. Average price change, you can see at the very bottom, 15.7% for all parties, up 84% of the time. Interestingly enough, for first-term Republicans, average price change was almost 22%, and it was up 6 of 6 times. Of course, the statistician would say, Sam, 6 observations really is not a is not statistically meaningful, but still, these are the kind of questions that people like to ask. Take that one step further. Look at year 4. Normally, the market is up 6.3% and rises more than 3 out of every 4 years. But again, in the first term of a Republican president who's looking to get reelected, the market has risen 6.6% and was up 6 of 6 times. So the market itself is looking to what might happen in the coming year as the current administration tries to get reelected.
So all eyes are on the presidential election, and I know, Sam, you also look at the composition. So not only the presidential election, but perhaps what lines up in terms of the House and the Senate.
Right.
What's to the market?
Well, traditionally, a split Congress has not been very good for the stock market because nothing gets done. There's a lack of leadership, vacuum in Washington, D.C. And so that's the kind of situation we're in right now. Of course, this year was very good, so those statistics could end up changing over time. But I find the more that you dip into different kind of screening factoids as it relates to political cycles, the fewer and fewer observations you have, and therefore the less meaningful those numbers become. But usually the best performances come when you have the president and both houses of Congress being from the same party, because if the president then introduces legislation, it tends to get rubber stamped by Congress, and that ends up being economically stimulative and favorable for GDP and for earnings growth. Whereas usually a gridlocked House and Senate ends up basically going nowhere, and the market is left to its own devices, which, thank goodness, were favorable this year.
And at least for the people's work, we got the USMCA trade. Looks to be one that at least is showing bipartisanship. But
right. And also, there's one other thought that I believe that the president will float the possibility of another cut in taxes, mainly from the standpoint of lifting the cap on SALT, state and local taxes, which you have the cap of what, $10,000 per year, which really adversely affects the very expensive high-taxed blue states, in particular California, Illinois, New Jersey, New York. So that would be something that you would think that the Democrats would go along with, but then the president obviously would get credit for that. And I don't think the Democrats want that to happen in an election year. But it's a win-win, in my opinion, if this is floated, because then the president would say, if the Democrats held it up, look, I'm trying to save you some money in taxes, vote for me and I'll make sure that it goes through. So whether they get the taxes or whether it gets held up, I think the president is probably going to try to swing that to his advantage.
That's an interesting to watch.
So now that you have your associate's degree in financial stock market history, let's turn to fundamentals itself. Like I said before, bull markets don't die of old age, but like humans, the older they get, the more unstable they become. But typically, they die of fright, and they're most afraid of recession. Well, our economics department basically is saying, look, blue bars are 2019 estimates, Orange bars are GDP growth estimates for 2020. The first grouping is for the world itself, 2.9% GDP this year, 3.3 expected for next year. Whether you look to developed international, which is relatively flat, or emerging markets expected to go from 3.7 up to 4.4, we're basically not forecasting a sharp drop-off in GDP growth expectations. So from a global macro 10,000-foot level, it still looks as if the economy is expected to be fairly solid, fairly sustainable, and as a result would be assisting of earnings growth.
So recession probabilities look to be going lower, wouldn't they?
Yes, especially if you look to the items on this chart, but also if you want to cherry pick, Europe itself is expected to go from 1.2 up to 1.4. This is coming from the IMF, says it expects to see an increase. UK itself is likely to go from 1.2 to 1.4. Other advanced nations from 1.9 to 2.4. So whether you look to our economics department or the IMF, it's either expected to be flat or higher for the year ahead. And then if you say, okay, well, if the GDP is expected to be improving, what does that apply for corporate profits? Well, this is data from S&P Capital IQ consensus estimates. The blue bars are the 2018 growth rates. The gray bars are the 2019 numbers, and the orange bars are 2020 forecasts. Well, you can see that in 2018, S&P 500 earnings were up almost 23%, which I remember was more than twice what was expected as of the beginning of January of 2018. So not surprising that 2019 earnings ended up stumbling because the bar was set so high. So right now we're looking for 0.5% basically, but in 2020, right now the forecasts call for more than 8% growth in the U.S., more than about a 10.5% increase in the developed economies, and then a near 13.5% expansion in the emerging markets. So to go along with GDP growth expectations, it looks as if earnings forecasts are showing an acceleration as well.
So even if the U.S., the S&P 500 at 8.2, in thinking of investing U.S. or developed markets ex-U.S., slightly higher percentage, but really isn't that off of a weaker and lower base in the previous year? So it really gets back to, are these economies growing?
Exactly, yeah, because you could say that 2019 was unfairly tarnished because 2018 was so strong, and on the flip side, 2020 looks great. Well, what's the old saying? You rarely hurt yourself by falling out of a basement window. So if 2019 numbers are so weak, well, then any kind of growth for 2020 would look fairly impressive. But like I said before, I believe that the reason that the market is going up in the face of corporate profits that are flat to slightly lower, it's because, if wrong, investors are saying that they're likely underestimating how strong earnings will be.
Not only earnings, but also perhaps strength of the U.S. dollar.
True. When we look to our forecasts, our belief is that the dollar should end up moving. This is the Federal Reserve Board's major dollar index, is likely to go from about 109 up to 111. So a slight strengthening of the dollar is projected. Now, I frequently get a question, Ken, about international. International has been the poor stepchild of the globe, if you will, for quite a number of years. I think at least 7 of the last 10 years, the international stocks have underperformed the S&P 500. So the question is, well, when can you actually start moving back into them? And I think that the market is telling us that things are beginning to look more attractive. This is a chart where the jagged blue line is a rolling 52-week relative strength, meaning what was the 52-week return for the S&P developed ex-US BMI, meaning broad market index, something similar to the MSCI EFA, divided by the S&P 1500 price. And what you can see is we were in between 1 and 2 standard deviations below the mean toward the latter part of 2018. But since the middle of this year, we have broken above its 39-week moving average, and we are seeing the moving average itself start to work its way higher. So from a longer-term relative strength perspective, you could say, well, now it looks as if we are coming off of the bottom, and maybe the clouds will be parting and some sunlight will show through. Of course, the next question is, well, wait a minute, but could this be a value trap? Maybe I'm buying a group that is low for a reason and will likely continue to be low. What this chart shows, again, is data coming from S&P Capital IQ consensus estimates. It is, in a sense, the developed nations, ex-US, divided by the PE on the S&P 500. So this is a relative PE, and again, you see that the relative PE for developed ex-US markets is more than 1 standard deviation below the mean relative to its long-term track record. So if you are someone who believes in reversion to the mean, it could possibly indicate that, again, should investors decide to rotate among stocks around the globe rather than retreat altogether, this might be one of the next areas of attraction. Now, of course, even though I am a Pollyanna at heart, and when life gives me lemons, I turn them into whiskey sours, I do have to acknowledge that, you know, some things could be going wrong. This is a chart showing that while prices have been exploding, earnings have been eroding. The blue bars show what has been the earnings projection at the beginning of 2019. S&P Capital IQ consensus estimates said that by the end of 2019, the S&P 500 will have racked up almost $172 in earnings. Now that forecast is for something closer to $162 in earnings. Ditto for 2020 estimates. It was a shade more than $191. Now it's something below $177. So this is a bit of a concern, but I think it all has to relate to the trade situation. If 45+% of the revenues for companies in the S&P come from overseas operations, the more questionable and uncertain the trade situation is, I think that causes analysts to say, I have to bring down my growth estimates.
And of course, early in the year, there's more optimism to realism later in the year, but perhaps here, not to worry about the economy as much as the trade issue, as you mentioned.
That's right. Going back over the last 20 years, on average, analysts have gotten the direction wrong 60% of the time and have overestimated earnings by a little more than 5 percentage points. When earnings went down, however, as we had 2 mega meltdown bear markets since 2000, they have overestimated earnings by about 13 percentage points. And when they were too conservative, they underestimated by about 6 percentage points. So in general, you're right, anything looks good a year from now. And so typically that optimism is found early in the year in terms of earnings projections. But 40% of the time, the analysts underestimated things, and so possibly 2020 could be another one of those underestimation years.
Great.
So if we take one step further, you know, again, acknowledging, well, if the earnings have come down but prices have come up, what does that mean in terms of PEs and valuations and so forth? This is a chart showing the price of the S&P 500, that's the bold, jagged black line in the middle, surrounded by PE bands. So the lowest one is that the S&P 500 is trading at 10 times projected 12-month earnings to the higher level, which is 18 times projected earnings. And as of last night, we were trading at 18.4 times projected 12-month earnings, which is a bit elevated when compared with the average over the last 20 years of 16.4. So, my feeling is that one of two things has to happen. We either digest these gains and wait for earnings to come in a little bit better, or we start to see an improvement in earnings so that the earnings themselves start to catch up to the valuations.
And in terms of reversion to the mean, this was a question that came in, was whether the S&P 500 on P valuation is overpriced or ready for a correction.
Well, when you do look to a lot of technical charts and whatnot, it does appear as if the market is certainly in need of some sort of digestion of gains. And even though December is the best month of the year since World War II, rising in price about 1.6% and being up about 78% of the time, 3 out of every 4 Decembers, we've had a month-to-date low. The Stock Traders Almanac calls it the mid-December low, which tends to be the only free lunch on Wall Street, they say. From the mid-December low to the end of January high, it's a fairly consistent and impressive advance.
And in a market where today it's really low volatility, so I guess it's the unexpected or some episodic event. What could be, I guess it's always the surprise. It's not what you're expecting.
Oh, sure. I feel that the market really sort of gets knocked off of its advance because of unanticipated events. Unfortunately, they're hard to anticipate. So you can only guess as to what might go wrong. And right now, I think the guess is that, if the negotiations between the U.S. and China don't go as planned, then the tariffs go into effect. Maybe we find that out on Monday morning, or we find that the threat is that the tariffs will be doubled if they don't agree to this by Sunday night. That could all be part of the administration's negotiation attempt.
And another question came in, I guess back to your point about the dividend yield, is equities the only game in town right now, versus alternatives? It's just an attractive place to be.
That's what it appears right now, but you bring up an interesting dichotomy because when I go back to 2008, people frequently ask me, did diversification fail us? And I say, no, our memories and our expectations failed us. We forgot that in a bear market, basically all types of stocks decline, and they confuse quantity with correlation, meaning just because you have exposure to large, mid, small U.S., developed international, emerging markets, REITs, and commodities, they're all economically sensitive. Really, the only asset classes easily obtainable that have low correlation are stocks and bonds. Maybe throw in gold as well. But actually, a portfolio of 60% stocks, 40% long-term treasuries did better in 2008 than it did in 1973 and in most of the bear markets in the 1930s. So I say now that, yes, stocks are the more attractive place to be, but unless you have a very timely, accurate, consistent, and forward-looking timing indicator, don't give up on diversification, especially if you're one that has problems sleeping at night.
That's a fair point.
This chart is really just sort of a summary of some of the fundamental data that I look at. So global GDP growth, 2.9% is the estimate this year, 3.3 next year. The U.S. probably will see a little bit of a softening going from 2.4 down to 2.3. But one of the things that is likely to be improving is fixed investment, which is what economists call capital spending. So going from 1.4 up to 2.6 is the expectation. Unemployment for the whole year likely to average below where it is in 2019, so that should be a benefit for the economy. But at the same time, we don't have to worry too much about inflation heating up too quickly. Year-on-year core CPI is expected to average 2.2% this year and then only 2.3% next year. Fed funds, we're not anticipating another rate cut in all of 2020, but at the same time, we don't expect the Fed to be raising rates either. The 10-year yield as of November 30th was expected to average around 175. Today, I looked at the number, it's 1.8%, but still well below that 2% level. Who knows where oil prices are going? But the expectation is that they will average below $60 a barrel. Earnings for the U.S. will be up 8.2%, but supported by revenue. So it's not a situation where we're getting earnings on no revenues only through share buybacks. It's actual organic growth.
So it almost seems, with the Fed, we go back to your term of a Goldilocks scenario where it's not too hot and it's certainly not too weak or cold. And then a question came in just about energy. We'll probably get to this later in sectors. But, oil prices have risen a bit, and supply is being cut outside the U.S., but energy just seems a tough area of investing.
Well, it is, very much so. I mean, we see a push toward cleaner energy. We're seeing concerns about climate change, the push toward battery-propelled automobiles, et cetera. And really, you see an awful lot of supply out there. Chevron is taking a write-down of $10 to $11 billion. S&P Dow Jones Indices sent out a report this morning saying that could reduce the earnings growth for 2020 by as much as 1.3%. So we'll have to wait and see what the actual write-down is.
Cam, one last point here, which I find interesting. If you look at the bottom at revenue growth, 2020 looks to be increasing, and I'm going to say this is organic revenue growth. So when we look at what feeds earnings, whether it's margins and buybacks, all of a sudden we're seeing a good-looking number here on growth for revenues in 2020. Is that another additive to the bull case?
Yes, I think it is, because if you have earnings growth that is coming from increased sales, organic growth that is not some sort of a manipulated accounting figure, then I would tend to say it adds more credence to that overall bottom line number. An interesting book written many, many years ago was What Works on Wall Street by James O'Shaughnessy. And he was saying that, if you're really looking for fundamental growth, don't look to price to earnings, don't look to price to book, because those two can be more easily manipulated. Look to price to sales by looking at the revenue line. Because, maybe you can accelerate revenue within a calendar, but it's harder to fudge revenue and sales than it is book value or earnings. Now, here's where we get to brag about how well we've done, because forecasts and whatnot are, everybody does them, but when we put our money or your money where our mouth is, it's always nice to have some areas to point to that have done fairly well. On our MarketScope Advisor platform, we have a multitude of different portfolios, lists of stocks or ETFs where we recommend based on whatever an investor's strategy happens to be. Are they growth oriented? Are they value oriented? Do they look for large cap, or do they look for mid and small cap, or even just global in nature? Are they nervous Nellies and they need some sort of a lower volatility, more capital appreciation with high quality? And here we see a whole spectrum of portfolios.
So bringing it back to the 2020 Foresight, Sam, is there two or three here on the screen that you think would be interesting in terms of fitting in with your 2020 strategies?
Yes, I would. Well, the 2020 strategy, again, we're looking for 34.35 as the year-end 2020 number, which implies, a mid 7% price appreciation at 2%. That's still below 10%. We are in the longest bull market, arguably, since World War II, actually since 1900. And so one would say, do I really want to be overly aggressive? So one of the portfolios that sort of would fit into this category is capital appreciation, high quality capital appreciation. Look for those companies that have favorable stars, meaning our stock appreciation ranking system. Our analysts go for growth at a reasonable price, but at the same time, let's overlay quality. We, as well as S&P, defines quality in one word: consistency. How consistently has a company raised its earnings and dividends over the prior 10-year period? So those stocks, there are 15 stocks right now in the high quality capital appreciation portfolio. They have buy or strong buy recommendations, but also have above average quality rankings or frequency of raising earnings and dividends. Another area is seasonality. We're finding that, seasonality, let's go back to the written word, right? Stop right here. So seasonality, the second bullet. Sometimes, like whitewater rafting, you let the market take you where it wants to go. Seasonally, this market likes to be cyclically leaning from November through April, but be defensively leaning from May through October. In end of April of 2018, the S&P 500 posted its third strongest year-to-date return since World War II. So it would easily have been understandable for an investor to say, well, I'm going to stick with these really high growth areas, whereas seasonality would have said, no, you're actually better off rotating to the more defensive sectors. And those who embraced that seasonal approach would have been rewarded because the market tanked in May of this year. Conversely, the defensive sectors did very well in the May through October period. So understandably, if an investor said, well, I'll stick with defensiveness because what's really changed, they would have missed out on a more than 3.5% price increase in November by gravitating toward the more cyclical sectors. So the seasonality is something that was turned into an ETF by Pacer Financial. If you want to learn more about it, go to pacerfinancial.com and look for the CFRA Stovall seasonal rotation strategy. So Ken, basically, if you're looking for quality, you're looking for seasonality, you're looking for momentum, growth, etc., there are a variety of lists out there on our website that investors might find rewarding.
And in terms of the sector, Sam, chairing the investment policy committee, where are we on the weightings, particularly to the ones right now overweight and any where you're underweighting on sectors?
Well, we toward the end of going with that seasonal rotation strategy, at the end of October, early November, we dropped utilities and consumer staples to an underweight. In particular, we felt that utilities were just an area that was asking for some problems because the sector was trading at about a 26% premium to its average PE and also an elevated relative PE versus the overall market. Yes, investors liked utilities because as being a bond substitute, you were getting paid more in utilities than you were in bonds, but we just felt that had been overdone. Ditto with consumer staples, our feeling was that the group traded at a premium to its own average PE as well as the relative PE, so we decided to take profits and recommend an underweighting there. Overweighting, we are more cyclically leaning. We elevated financials to a market weight. We have technology and communication services as overweights because we're looking for an improvement in earnings, an improvement in revenues, and also seeing either an improvement, such as in financials, or a maintenance of the above average relative strength from a technical perspective for communication services and technology.
And besides sectors, for everyone, Sam in his weekly Sector Watch also gives really great commentary analysis on sub-industry performance, which makes up ultimately sector performance. Let's move on. Okay. Checking to see if there's any other questions from the field. Certainly this has been a very interesting and timely time to look to 2020. Sam, I want to thank you for today's presentation on behalf of the team at CFRA. We also would like to thank you for joining us today. and within the next day, you'll receive a note from us with a link to the replay and slides from today's session. For those of you who subscribe to our MarketScope Advisor platform, you will find many of the analysis we've covered today and much more. If you are interested in learning more about MarketScope Advisor, please visit our website, www.cfraresearch.com, to request a trial. Thank you, everyone.
Great. Thank you, Ken.